Welcome to Financial Education for the Nation. My name is Warren Shute. I just want to give you an update of the current tax rates, all the changes that happen. Now we're in the new tax year. So new tax year started April the 6th, and on April 6th we then have different allowances and things to take care of for this year. So the outcome for me for telling you this information is primarily for you to take note of it, and if you think, oh, I need to know some more about that, then to delve deeper. So first point of call probably is going to be to your accountant. If you've got an accountant, HMRC have a good helpline if you want to call them. Try the Wayfinder website for a CFP, a Certified Financial Planner. So that's wayfinder.com, I think it is. Or just Google Wayfinder, you'll find it. And or get in touch with me, by all means. Please ping me a Facebook message, Twitter direct message, or email me. Very happy to respond to any of your inquiries. So we'll start off with personal allowance. So personal allowance is the amount of money you can receive tax-free on any income you generate, either salary or dividends. That is $11,850 for the current financial year. However, when your income exceeds £100,000, that personal allowance starts tapering down. It starts tapering down from £100,000 to $123,700. And then over $123,700 of total income, you have no personal allowance, so nothing at all. Now, the most important thing to remember on this is that your income between £100,000 and $123,700 is taxed at 60%, 60. That's a massive take. So therefore, you really need to look at ways to, if you're in that marginal band, look at ways to reduce your income down closer or below £100,000, because every pound you get down is going to save you 60p in tax. So certain things you can do: personal pension contribution, that will reduce it down; charitable payment, that will reduce it down; or consider asking your employer to sacrifice some of your pay, bonus, or income of whatever form it is into a pension. If this affects you, certainly worth paying a professional to get some advice or delving deeper. Give us a message and I'll cover it in a little bit more detail some other time. Tax rates, 20% up to higher rates, so that's about £34,000, £34,500, 40% up to 150, and then it's 45% over the 150,000. Remember, if you're an employee of a company, whether it's your own or not, and you take salary, you've then got national insurance on top of that. So the employer is going to pay national insurance over the £8,424, and they pay at 13.5%. And as an employee, sorry, that's the employer, as an employee, you can pay national insurance at 12%, pretty much, on most of the money. There's a bit tax free at the beginning, the $8,424, and then you pay 2% over the excess, the higher rate, $46,384, I think it is. So they're the main taxes on your income. A lot of business owners will be listening to this, and you tend to remunerate yourself by dividends. And the dividend allowance last year was £5,000. That's gone down to £2,000 this year. So bear in mind, it's going to mean you're going to, for a high rate taxpayer, you're going to have an extra about £1,000 income tax to pay in your self-assessment. So bear that in mind. Maybe speak to your accountant, just get a forecast of what your tax likely to be for this year. It's always, well, good people organised. Step 2 of the money plan, be financially well organised. And then your dividends are being taxed at 7.5%. or 32.5% if you're a basic rate taxpayer, or 38.1% if you're a high rate taxpayer. Remember, the taxation dividends changed a couple of years back, so you're now paying tax on all of your dividends personally. £2,000 tax free, 7.5% up to higher rate, 32.5% at higher rate, and then 38.1% at additional rate, which is over £150,000. Okay, so that's sort of income, taking money out of the company, and however you remunerate yourself, whether you're a partnership or sole trader. Dividends we've covered. Capital gains tax, 11,700. Half that for trusts. And then remember, if you're a company and you sell your shares, you've got £10 million of capital gains tax at the entrepreneur's rate. So you get a special rate of 10% on the first £10 million, which is great. Capital gains tax for everyone else is 10% for basic rate taxpayer, 20% for high rate taxpayer. But buy-to-let investors, this is where you're stung again. You're getting taxed an extra 8% surcharge, so 18% on buy-to-lets, or 28% if it takes you into high rate. So, this government really doesn't like buy-to-let investing. So buy-to-lets over the years have become progressively more and more taxed through loss of interest offset against the rental income, stamp duty, and obviously the capital gains tax. So, and loss of wear and tear allowance. There's lots of it. They really don't like you, unfortunately. Sorry, guys. Moving on to inheritance tax, first £325,000 from anybody's individual estate can be left tax-free. In addition to that, we have the residential nil rate band, which now sits at 125,000, which means if you leave your main residence to a direct descendant, you've got the 325 personal nil rate band, plus the residential nil rate band of 125, so that's 450,000. It goes tax-free per person. So married couple, £900,000. That £125,000 of residential nil rate band is rising by 25,000 next year, tax year, and 25,000 the tax year after that. So eventually it'll be at 175. The theory behind it, 175,000 residential nil rate band added to your nil rate band of 325 is £500,000. Plus your partners, significant others, married couples, it's now £1 million tax free. And that's where the £1 million estate, and if you ever saw the headlines in the press that they were talking about. So 325,000, but if you're leaving it to direct descendants, another 125,000 for your main home. So that's £450,000 per individual. Let's move on to ISAs. Talk about ISAs very quickly. ISA allowance, £20,000 again. In addition to that, you've got your 4,260 for your junior ISAs. This is for your children, 18 years or below. If they have child trust funds, they can be moved into junior ISAs now. And you also have your LISA for people age 18 up to age 40. So when you're over 40, it doesn't include you. So 18 to age 40, you can put £4,000 into a lifetime ISA, also known as a LISA. The government gives you a 25% bonus on that, so up to £1,000 gets added. And that you can save into that until you're age 50. And that money can be used for one of two purposes. First one is to buy your first home, valued at £450,000 or less. And the second purpose can be retirement from age 60 onwards. Okay? Leases, love them, think they're fantastic because you can get the money if you need to before retirement, before 60, but they just charge a penalty on it. So if it's really that dire, you need that money, you can access it and there's a penalty. But the penalty sits such a level that you wouldn't access unless you really, really, really needed to. Pensions, last section, just on pensions, quick overview, £40,000 annual allowance for anyone earning £110,000 or less. Now, when you hit £110,000, you then need, that's your threshold income, you then need to look at your adjusted income. Okay, your adjusted income is your total income plus your pension contributions. And when your adjusted income, your total income from all sources, including rent and interest and everything, so it's not just your earnings, it's every bit of income you've got coming into you, plus all your pension contributions, whether your company makes it or you make it, all gets added together. When that exceeds £150,000, your annual allowance of £40,000 starts tapering down. Okay, it starts tapering down for £1 for every £2 over the £150,000 threshold. So we get to a stage when we're at total income, pensions, everything else of £210,000 a year. Your pension annual allowance is £10,000. Now this is for this year and for last year as well. It's really, really difficult as a financial planner to plan my clients' pension contributions because we don't know what they will earn until the end of the tax year. And of course, I'm telling people pay in monthly, pound cost averaging, maximize your pension allowance. We could get to the stage at the end of tax year when they are over £210,000. So they've got a £10,000 annual allowance, but actually we've funded £40,000. We don't at Lexington because we would do things differently. We'd only fund for 10 and then make the top up at the end. But the challenge you're in is you really need to know what your total income is, to have a good idea what your total income is. If you expect it to be over the 150 when you add in all your pensions payments, then just fund for £10,000 and at the end of the tax year just do a top-up payment, unless you've got previous year's unused allowance that you can carry forward. Okay, then lifetime allowance, the last part of this presentation. Lifetime allowance is basically the total money you can save up during your lifetime from all sources other than the state pension, or pension sources, shall I say, £1 million. If you've got a defined benefit pension scheme, let's say, for example, it pays you £10,000 a year pension, or will pay that, that's times by 20. So you've only got £200,000 worth of value there. You've only got £800,000 left. The defined benefit schemes can quite easily take up a big chunk of your lifetime allowance. So added together, all your defined contribution schemes, that's £1 million, unless you've applied for previous protection. So quick overview of the tax rates, capital gains tax rates, everything else. Use your allowances early. So in other words, start paying into your ISA now. Don't leave it 12 months. Start funding your pension now. Don't leave it 12 months. Be in control of what's going on. It will be in your advantage. Thank you for listening. My name's Warren Shute. This has been Financial Education for the Nation. And one last point before I let you go. I've been working my way around the country this year, doing presentations to groups of employees. Big companies have brought me in to speak to their employees on like wellness days and employee feedback and training days, and also associations and groups and clubs that get together. If you have a club or if you have a company that has over 20 staff you'd like me to come and present to, it doesn't have to be 20, but generally speaking, the larger the audience, the better the engagement and the better the feedback. And obviously not every one of your employees will want to come. I'm very happy to come out and speak to you. I do a presentation called The Money Plan. It covers the 5 steps in my book. Setting goals, getting financially well organized, sorting out your financial foundations, to your basics, everything from wills, power of attorneys, life cover, what it all means to you, repaying your debt, and then saving for retirement. I tailor the presentation to the audience, so I can also include the specific benefits if your company has any employee benefits. I can make sure that they're included within the plan and within the presentation as well. If you'd like to know more about it, get in touch. I've got footage of me speaking. I've also got a copy of the slides that you're welcome to have a look at beforehand. I'll be very, very happy and pleased to come and do that for you. No charge, no fee. For me, it gets the name of the money plan out there around the audience. I want to impact as many people as I can. And for you, you're giving a nice feedback to your staff. And the feedback so far has been tremendous. Lots of good engagement, lots of people saying thank you. So that's all for today. Thanks for listening, and I'll catch you next week.